Hi and welcome to the Data Explorers Daily Update, where I'm very pleased to be joined by Paul Wilson, Managing Director of JP Morgan, where we're going to take an aerial view of what's happening in the securities lending and borrowing landscape during these tumultuous times. So we were just discussing what a summer it's been, slightly reminiscent. You pointed out we're close to the anniversary of Lehman's bankruptcy, 3 years on. And one place that's going to go into this discussion is kind of have the changes made over the last few years kind of stood the industry in good stead, to react to what's been going on recently.
Yeah, interesting times, Will. I mean, I think that notwithstanding some of the current turmoil that's in the market, there are a number of positives for the securities lending industry. I think a couple of points that I look at is firstly, whilst we have seen some short selling bans put in place by a number of markets around the world, is much fewer than we saw previously in the 2007 and 2008 timeframe. The other barometer I look at is if we think back from that time, from August 2007 through to September 2008 and beyond, clearly the market experienced a number of the beneficial owners, deciding to exit lending, to scale back their activities quite considerably. And whilst the industry's recovered to a greater degree in terms of people returning to the market, perhaps with increased focus on risk management, what we've clearly seen over the last couple of months, where the markets have been challenging, is really client reaction to that has been pretty much muted. The vast majority of lenders in the marketplace have stayed the course, which does seem to suggest to me that the lenders today have the type of programs that can function through any market environment, and I think that's a real positive.
So we had 4 short selling bans as opposed to carte blanche across all the markets, and then no real beneficial owners leaving. That's definitely showing the improvement that has made, and people are kind of not pretty relaxed about it. Also, it's interesting, the short selling bans, that hasn't stopped the share prices falling of the financial shares in France, in Belgium, in Spain and Italy, right? So are they looking clever or less clever by those bans?
Yeah, I mean, I think that the argument is almost over as far as I can tell. I mean, the evidence that's out there just over the last 3 weeks, as you mentioned, those markets, bans were put in place, but yet we've still seen volatility in the markets, and some days the market's falling 3-4%. And that's with a short sell ban in place. So I mean, you couldn't look for any more empirical evidence that there is not much correlation between short selling and market declines, which I think we all know are really driven by the fundamentals.
Right, exactly. So let's go on to the sort of the profitability, the income from lending. You run a big lending business. We know interest rates are low, and from whatever we've heard from central bankers, they look like staying low for some time. Clearly, making money for the cash for investment is a big driver of profitability. So how are you coping with this sort of low interest rate environment and this slightly subdued demand to borrow stock?
Yeah, I mean, I think they're all fair comments, and I think that being said, 2011 has been an overall a really positive year for our business. I mean, our inventory's increased, our on-loan balances have increased, and the number of clients that we have in the program has also increased. And many of the new lenders in the program are people that are lending for the first time. I think that the issue that the industry has been debating probably for all of 2011 is what I'm going to call the mismatch between the supply side and the demand side. And on the supply side, lenders want to keep loans short term with high quality collateral and for very high fees. And on the other side, broadly speaking, on the demand side, the borrowers want to borrow for term for low quality collateral for very low fees. So there is this little bit of a mismatch
that exists. Going on.
Well, maybe more of a mismatch, Will, but nevertheless, so what we've been spending a lot of time is working with both the borrowers and with the lenders.
i.e. your beneficial owner clients.
Yeah, our beneficial owner clients to look at how they could structure their programs, look at collateral types, look at some of these as almost one-off transactions to try to resolve some of the mismatch that exists. And again, it's been a really healthy year for us in terms of our beneficial owner clients being willing to be open to looking at expanding their lending activities. Not to suggest that they're willing to take on more risk, but looking at ways in which they can perhaps take advantage of some of this mismatch that does exist between the supply and the demand side.
Yeah. So gone is the sort of the lending to drive, short selling and feed the hedge funds, and it's more now about kind of a collateral management, helping borrowers, maintain their capital adequacy and matching the right kind of supply to help the borrowers get what they need to, to deal with their capital adequacy.
Yeah, absolutely. And in terms of that, we've been, sort of been quite active with our clients around equity collateral, and I think that we are now well into double figures of the number of clients across our program that are, accepting equities as collateral. And our clients are not necessarily seeing that as increased risk. And I think that goes some of the way to look at the type of transactions that need to get done in the market, because of where the demand side is trading right now.
Right. So let's go on to talk about central counterparts. We've got to obviously discuss that. Are we any closer to seeing these, forming a material part of the market? And if we're not, what do you see as the sort of what's going to push that forward? We know that regulators are very keen on this approach, but so far it's sort of it's not becoming a mainstream thing.
Why did I know you were going to ask me that question, Will? The CCP debate. I kind of think that the debate, if I can call it that, has probably moved into more of a healthy environment right now. I think it's less argumentative than perhaps it was a year ago. Don't look at me. But I think it is, it's almost a healthy debate. I mean,
consultative. You described earlier. Gosh, how touchy-feely are you feeling today?
Well, very, very much. I think that the debate is still open. Okay, when we talk to our clients, there still is a lot of unknowns. Okay, and I think that what we have to think really, really, really about is that to what extent will CCP be good for this market, or will it not be good for this market? Because the CCP is not the answer to every problem that exists in the financial markets. And some of the things that we hear from our clients around the CCP debate is, currently when a lender enters into a transaction, typically they're receiving collateral and typically they're receiving it with a haircut. From what I can tell, when you operate in a CCP environment, both parties to a transaction are providers of collateral or margin to the CCP. So some of the beneficial owners would have to think about whether, instead of receiving margin or collateral with a margin, they now would be payers of margin. Right. And so I think that we really need to think about that, and to the extent that the CCP could, in a relatively low revenue environment, drive amount of the supply out of the market. That being said, we've got to, give them a right of reply to kind of address these head on, and I think we've got some answers that we can put in today's story about an FAQs on that front, because it's still not properly understood, and that is the classic reaction from the beneficial owners, and then the CCP providers cry foul, and that's where we are. We need to get into the details of this. Absolutely, we need to go through, transaction life cycle, from transaction initiation all the way through settlement, marking to market, as well as through a default, and understand how it will work. I do feel, that there will be some areas, even within the market today, where a CCP will be beneficial. There are going to be some lenders who will be willing to lend, and perhaps lend directly to a hedge fund, and a CCP seems like a natural place for that to occur. Yeah. Similarly, there are some markets and countries out there where there is uncertainty around collateral and collateral netting, and in a Basel III environment, that is going to be very, very expensive business to transact. And again, a CCP seems like a logical answer to that particular dilemma. Yeah. But whilst I'm not going to predict where I see the end game, because I think there is a long way to go, I definitely see that there is similarities to what happened in the Forex market, where CLS came along as a central settlement engine between the interbank market, and the professional market operated on a bilateral market with the banks outside of the CLS, broadly speaking. Right. And I see something very, very similar perhaps evolving in the securities lending market, where market counterparty to market counterparty business is transacted via CCP, and kind of the lender market is perhaps transacted outside of the CCP. Right. But at the end of the day, I think it's great that there is a choice. I've always been on record as saying, for the beneficial owners, having a choice is really, really important and really, really healthy for the market and the industry.
Great. Well, that's going to roll and roll, but we're slowly getting to the details. So finally, I'm going to give you the home run for you to say what JP Morgan are focused on at present, and let us all know what great shape your business is in.
Yeah, thanks, Will. I mean, first and foremost, I think the markets have been choppy. So, focusing on our clients, helping our clients understand the current market environment, and helping them work through that has been paramount of our focus over the last 3 to 6 months.
So more reporting, more disclosure, more discussions, more contact with your client base.
Absolutely, and I think again, going back to something I said earlier in the conversation, generally speaking, the client reaction to the market events has been somewhat muted.
Right. And that dialogue has kept them lending, kept them in the program, and we haven't seen the kind of people flying to the hills like we did 3 years ago, which has got to be a good thing. Absolutely.
Secondly, for us, we're heavily engaged in a replatform of the business from a technology perspective. We're very, very much focused on emerging markets. We see significant flows of money into the BRIC countries. We see good opportunities to lend in those. I mean, we're up and live in Brazil, up and live in Malaysia. We have India, Russia on the horizon that we're looking at. We think there's good opportunities there. And we continue to look at collateral expansion. We feel collateral is becoming really, really key and critical and pivotable across all of the financial markets right now. Yeah. So collateral expansion, helping our clients understand the risk-reward profiles of different collateral is something that, again, we're spending a lot of our time and energy on. Right. And then lastly, we typically not in the business of building supply for supply's sake, but we continue to build out the type of supply what we think that the market is looking for. And as I've mentioned earlier, the fastest growing part of our business right now is the third-party non-custody business, where we've seen a really, really good increase in that type of business this year.
Right, excellent. Good. Well, I hope when we next have a chat in this kind of format, the markets have calmed down a bit and we're not talking about further ruptions. Hopefully they'll calm down. Many thanks, Paul, for giving us some of your time. And if you'd like to read the report that goes with this interview, it is in the usual place at dataexplorers.com/news.